Yeah, so good looking crowd. Appreciate you all being here. We obviously did okay in the first one because a lot of the people who were the first one came back for the second one. So thank you for those who are here, but also thank you for the returners. So, and yes, I'm gonna figure out how to juggle this, right? Okay. So there are quite a few attorneys in the room. So I'm going to start with, we're going to give you the best information we can today, but this is considered education opinion, not personalized advice. Yeah, I think I can juggle it. Okay, so success comes from focusing on getting the most out of controlling the things you can control and limiting the time you spend on the things you can't control. Our job as advisors is to help you focus less or spend less time focused on those things you can't control, like the market, and help you execute the things that you can control. I probably should have told y'all to run it for me. Most things you can control in your personal finances can be broken down to 5 categories. Making smart decisions about your money. What we spoke about last time, mitigating your taxes. Taking care of your heirs. Making sure your assets aren't unjustly taken. And magnifying your charitable gifts. So, like I said, last year, we started this Strategies for Success series with a panel of experts from BCR that talked about mitigating taxes in your investment portfolio. No one wants to pay more than they should in taxes, but asset location and several other regularly missed investing concepts can have a significant impact on the taxes you pay over your lifetime. If you missed that talk, you want to know more, we posted a 30-minute video on our website that you can watch. So let's talk about what we're going to do tonight, thinking about making smart decisions about your money. Okay, so you came to think about what are we going to do in 2024? Okay, can y'all all read this? Because it's kind of small probably on these screens, right? So this is 2023, okay? Look at 2023. For those who can't read it, let me tell you, we got the headlines matched against the S&P 500, okay? Based on the headlines, it was a pretty rough year, okay? It took 15 ballots for Kevin McCarthy to be elected Speaker of the House. The FDIC took over Silicon Valley Bank and Signature Bank. Household debt balances crossed $17 trillion for the first time. Kevin McCarthy was removed as Speaker of the House. Hamas attacked Israel. Sandra Day O'Connor died. And of course, no one will forget Taylor Swift went to a couple of football games. But through all that market turmoil, as you can see, we had a pretty good 2023 in the markets. So 2024 promises at least as big a eye-popping headlines, possibly bigger. We've got an election year. They're going to shine a light on the worst things our politicians can throw at each other. So with 2023 ending on a high note and volatility continuing on the horizon, we have to design investment portfolios according to what we know happens in the markets, both up and down. And then we have to know what to do when those headlines fill our lives. So if you were here last time, you probably remember studies from Morningstar and Vanguard and Envestnet show that this part of making smart decisions about your money has likely the most significant impact on your long-term investment. So we brought in Christian Newton. Christian is with Dimensional Fund Advisors, flew in from Austin, Texas. When you think of index funds, most people would say Vanguard. But in fact, the academically driven team that created the first indexes was also the group that started Dimensional Fund. With the desire to bring that academic science of successful investing out of the textbooks and into the markets, Dimensional moved beyond index to design the first and only research-driven asset class mutual funds that can only be accessed through approved independent financial advisors and institutions. If you're interested in bumping into a Nobel laureate, I suggest your best chance is likely to be at one of the Dimensional offices, as they have 5 Nobel laureates that are associated with them. Christian pointed out to me that the founder, David Booth, likes to point out they didn't pay for those people to join them. They had those people, and then they got Nobel laureates. A little bit about Christian himself. Christian is a VP and regional director with Dimensional. He's been with DFA for over a decade, helping firms like BCR leverage capital markets research and its application to portfolio and practice management. Christian graduated from the University of Massachusetts at Amherst, and his writing has been profiled in the New York Times and Entertainment Weekly. Welcome.
Marshall, thank you so much. Thank you very much. Thank you for that kind introduction. There we go. Good evening, everybody. Good evening. It's a thrill to be with you. What I want to do in just a few minutes is I want to share with you what I believe are 6 valuable lessons for how you can invest successfully in the year 2024. Where can we find those lessons? I believe the best place for those lessons is the recent past and your media diet, the modern media diet. Now, like you just heard in that introduction, my firm, Dimensional Fund Advisors, is an exponent of high-quality, peer-reviewed academic research. We are all about detailed portfolio engineering and large amounts of statistically significant data. But you can rest assured that tonight you will have to see none of that stuff. Rather, what I want to do is I want to walk through a, admittedly, non-statistically significant, cheerfully cherry-picked survey of the modern media diet and how that informs our sentiment as investors. Now, I noticed Marshall did not warn you. This presentation is better with a glass of wine. It may not be too late. Even better with 2. After 3, you're on your own. But this is intended to be largely a fun presentation, but fun with a purpose. So I want to walk you through these 6 ideas. If they generate questions, objections, or follow-ups, I'm thrilled to hear those as we go. If you want to hold them until the end of the presentation, I'd love to get those questions as we wrap up. Now, when I say today's media diet, it is my thesis that our collective media diet has been significantly transformed in the last 15 years, largely by the internet. And I don't only mean how you get your news, I also mean the nature of the news itself. And the internet, of course, is older than 15 years, but I choose 15 years because of that very powerful, magical device. It may not be in your hands right now, but I'm very sure you know exactly where it is. I am talking about the smartphone. So to walk through these 6 lessons, I actually want to use some internet acronyms. And don't worry, I'm starting with the hardest one. FUD. Has anyone ever heard of this concept, aka FUD? Sir, do you know what it stands for? Will you hazard a guess?
I've heard of it. It's fear, understanding, and distrust.
You're so close. It's like a hand grenade. Fear and distrust, I'm all about that. I need the U to be uncertainty. Okay, if we're on board with that. That's the key letter that I am looking for. So I want to start just by warming up with some print media. Why is it that print media puts such a priority on images of fear? Consider, if you will, the case of The Economist magazine. Now, if you get The Economist like I do, you know there's a big distinction between receiving The Economist and actually every week cracking it open. Because if you subscribe to this magazine, it's a British magazine, they call it a newspaper, it's clearly a magazine, you know that every week you're going to get really high quality journalism. What's happening in the world, what's happening in capital markets, what's happening in finance, business, and innovation inside the magazine. But I'm particularly fascinated by their cover stories because I have to admit it's really easy after a few weeks on the road. I come home to a coffee table covered with Economist covers, and the only thing I read is the cover itself. And to me, it's interesting, given the high quality journalism inside, how often the editors of The Economist use really powerful images of fear when it comes to investing. After all, here we are in May of 2010. If you allow me to take you back to May of 2010, of course, we were still swimming out of the depths of the global market crisis. And The Economist's estimate of what's going to happen in U.S. markets is the following: fear returns. How to avoid a double dip recession. And you can see they've characterized the act of investing as, I believe, one of the scariest things in the collective human unconscious, which would be the dorsal fin of a shark. Now, as you're all keenly aware, it is no longer the year 2010. We stand, believe it or not, in the year 20 and 24, which is really getting up there. It really sounds weird to say out loud. So we have an advantage that we did not have in 2010. We have the advantage of hindsight. We can audit the editors of The Economist. Was this signal of fear useful for us as investors? Did it help us to avoid a hideously arterial, red ink covered negative return experience? How did markets do in the 6 months that followed the publication of this issue? Were markets down? Were they sideways, or were they up? Well, I already warned you, this is cheerfully cherry-picked evidence. So you can guess what I am going to say. Markets were not down, they were not sideways. Markets were significantly up. Over a 6-month period, up 10%. That is well above average if we consider a typical return we might experience in an average year. This was summer reading in 2010, and they were unfortunately, probably fortunately for us, dead wrong. But especially with sharks, everyone loves a sequel. So the next summer, those same editors were back. And I will give them points for at least now including a question mark. I know we got it wrong last summer, but perhaps now is the time for a double dip. It's August of 2011, and there's growing fear of another American recession. And you can see they've turned the Spielbergian imagery up even more strongly. Well, what kind of a negative experience did the editors of The Economist save us from? Down, sideways, or maybe even up? Well, again, cheerfully cherry-picked the Dow Jones Industrial Average, not down in the 6 months that followed, but up 13%. Signals of fear, especially animal imagery. It's a fascinating quirk of the coverage of markets. Accidental wisdom department. MarketWatch.com is not what I would call high-quality investments journalism, but I think there's accidental wisdom in this headline from 2017 that I want to share with you. Frustrated traders say that stock market swings show that neither bulls nor bears are in charge. And when journalists use these animal images, we all intuit what they are talking about. We all know what a bull market is. A period of incredible expansion and success, rewards for us as investors. And we also know what a bear market is. That's a period when there is pessimism, distress, fear, uncertainty, and dismay, and markets tend to be going down. And these animal images, to me, do kind of bring to life this sort of back and forth, this competition in markets. But I want to cite something that I think is accidental in this headline. Neither bulls nor bears are in charge. Now, in 2017, markets did to some degree go sideways. But I want to argue that it is not an uncommon condition for no one to be in charge of markets. In fact, I believe one of the unique qualities of capital markets is that no one is in charge. That may strike you as unpleasant or scary. That is okay. There is uncertainty in markets. What do I mean by no one is in charge? I don't mean we don't have laws or rules or contracts. But what I mean is no one party controls the results that come out of capital markets. That would be the reassessment of the value of every investment on planet Earth, every share of every operating company, every bond, and every contract of a commodity on the planet. Every day they are auctioned off. And in a true auction, in an auction without confederates, in a fair auction, who controls the resulting price? I heard a lot of answers, and they're all great. I would argue no one party controls the price. The auctioneer does not control the price. It's a sum result of the competition, the sum perspective of all market participants. The same thing happens in capital markets. Bull and bear markets, those are useful labels only in the past. No matter how long or short a bull or bear market, it does nothing to guarantee what capital markets are going to do the next day, the next month, the next quarter, the next year. No one is in charge of capital markets, the prices they produce. That may strike you as unpleasant. I want to argue that is good news for you, especially given the way, at least I'm going to stipulate for now, the way we all in this room invest. We will return to that idea later. But to come back to my original acronym, I simply want to make this argument. We do not need fear to invest successfully. We can find ways to put that aside. But we do need uncertainty. The expectation of positive return requires exposure to uncertainty. What kind of uncertainty? That is a really valuable question that I believe an advisor is best equipped to answer. But the media can really distract us with these signals that give us a sense that someone is in charge of markets, that there's some sentiment that's absolutely going to dictate the return of a particular year, a particular quarter, or even a particular market day. Let us move on to Chapter 2. Much easier acronym for all of you, FAQ. Frequently asked questions. Well, I want to stay with magazines for a while, and I know someone very smart once suggested that print is dead. And that may be true. So we will move on to what are perhaps more powerful media, but for now I want to stay with magazines. And I just want to warm up with the curious case of Forbes magazine, specifically their investment guide. Now, they have published an investment guide since the 1980s, every year bringing together all the important information you need in order to invest successfully. But I started to notice in the 2010s an interesting, if you will, inflationary pattern in these cover stories. Here we are in 2011, and the investment guide headline is 10 Steps to Make Your Kid a Millionaire. And we sometimes have fraught relationships with our children, but I think most of us are willing to take 10 steps to help make our children millionaires. But I noticed something interesting the next year. We went from 10 steps to 20 new rules of money. That's a little more work to do, but I'm still possibly intrigued. But you may have guessed that there was a pattern in motion, and indeed there was. We went from 10 to 20, and then in 2013, we went all the way to 81. You can almost hear the editorial meeting where they said, all right, we did 20 last year. I know some of you managing editors are thinking we're going to ask for 40. Well, no, I'm not going to ask for 40. I'm going to ask for 80. 80 things to get our readers to read our magazine. And perhaps it was the intern at the end of the table who said, well, if you can do 80, why not 81? What is magical about that number? I don't know. And it came to pass just 6 months later, there was a special issue because now we can get rich from Obama. And now we have 43 tactics and 70 ways to expand our wealth. We are in excess of 100 tasks to do each year. And yes, in the year 2014, it came to pass that Forbes magazine suggested that there were 365 ways to get rich. And I want to humbly submit to you that if you are doing 365 things in a year to get rich, that is not investment advice. That is called a job. To go from this very light example to a more serious concern, again on this idea of our wish for voluminous answers, I want to interrogate a curious habit of really high-quality journalism, like I believe you find in the Wall Street Journal, just to pick one newspaper out of a hat, about why markets did what they did. Isn't it simple to say why markets priced all of these securities in a particular way? Well, I think journalists can get us into trouble by oversimplifying that. Now, there are exceptions to the rule, exceptions to what I will argue is the rule in any case. And one of them perhaps is March 12 of 2020. I hate to take you back, but that is my job here tonight, to take you back just for a minute in your mind to this particular headline where, yes, that 11-year, the longest running bull market we had in U.S. markets finally came to an end as markets were discounted 20% in a single market day. Or to be more careful, most of that drop occurring in just 2 market hours. That is how fast capital markets work. Well, Why did markets drop that much? Why was the value of all these companies suddenly discounted? Well, I know you all remember why. The coronavirus was no longer a possibly distant, possible crisis. It was an immediate crisis. And if not a crisis for us personally, absolutely for all the companies that the stock market represents. Every one of those operating companies was going to have to go through a lot of change in order to keep doing what it was doing. And that uncertainty resulted in a discounting of securities on that day. And on that day, I want to argue that the Wall Street Journal did get it right. Blue chips fall 1,500 points as coronavirus imperils economic growth. On that day, I think that headline does capture everything. That's how dramatic and hideous that day was. But on a typical day, even though I believe journalists are trying to do their best, I think this wish for specificity can get us into trouble. After all, consider the amazing recovery that followed March and April of 2020. Even people considered by many to be experts like Jim Cramer were suggesting skepticism in light of the unusual rally we experienced over the summer. Now, citing Macbeth in an investment story is hard to do, but Jim Cramer figured out a way to do it. A tale told by an idiot. Don't be fooled by the new highs in the stock market. He, of course, turned out to be wrong, at least for now. But even high-quality journalism like we find in the Wall Street Journal, I believe, suffers from the same mistake. I'm not saying they're wrong. I'm simply saying these assessments are incomplete, and they can give us false confidence as investors. When markets hit all-time highs, like they did about a year later in 2021, here's the headline: U.S. stock indexes closed at records. Why? Stocks rose as investors wagered that a new round of stimulus spending would bolster the economy. And I'm sure on that day that was true. But I also know, if I'm thinking about all 3,000 stocks, more or less, in the U.S. market, and why everyone traded on those, a true headline to characterize why markets did what they did, we would never find an end to it. I know an answer like this is necessarily incomplete. True when markets reach all-time highs, and true when markets stumble from those highs, as they did just a few weeks later. Why did the market close lower? Well, the Wall Street Journal wants to tell us why. S&P 500 ends rally as investors assess gross domestic product data and weekly jobless figures. But again, if we're being careful about the fact that no one controls markets, that there's no one narrative that controls what markets do in a particular day, I know that the true answer to why the price was the price is going to be a run-on sentence that never ends. There's no simple narrative to explain what markets are going to do. I believe that can give us a false sense of security. Before we move on, I do want to mention very briefly my personal favorite cover story in an investment newsletter or newspaper, as in the case of Barron's. And this would be from 2013. And it is a stock alert. Now, in October, before they published this issue in February, the editors of Barron's made an incredible prediction. I hope you're sitting down. And with one exception, you all are. Hey, the stock market on average is going to go up. And they were so proud that that prediction came true, and they're only 1% short. And this is not what I did in PowerPoint. This is what the editors of Barron's magazine did themselves. They took the cover story of Barron's, and yes, they put it on the cover of Barron's. That's how proud they were. But take the perspective perhaps of a pessimistic investor. When they see a headline that says stock alert in red with an exclamation point, get ready for a record on the Dow, I think that's supposed to be good news. But what does a pessimistic investor say to themselves? I don't want to be the greater fool. I don't want to be holding the bag. I know what happens when markets hit all-time highs. They trip and they stumble. This is a sell sign, not a buy sign. Again, we have a wish for answers, but I think the media leaves out too many details. There are too many answers. All right, I have beaten up on the print media enough. So we really need to address the elephant in the room. That would be television. And so for our purposes here, OMG is going to stand for I watched 24 hours of CNBC, so you don't have to. It is true. In the summer of the pandemic, actually September of the pandemic, I had incredible cabin fever. I typically travel, speak for a living, but I was stuck in my basement. I had not left the house in many weeks. I didn't want my wife to take that personally. But I was starting to go a little crazy. So one day I had this idea and I said to myself, hey, I'm just going to lock myself in our guest bedroom. I'm going to treat it like a hotel room. I'm going to have my laptop. I'm going to do my job. But I'm also going to watch bell to bell the entire day without interruption. I'm going to watch CNBC. I'm going to watch Finance TV. I want to see, because typically as a professional, I completely ignore everything these folks have to say. And I survived that experiment, and I want to report my results to you tonight. My first reaction, an unexpected reaction, was empathy. I actually think what these often guys, not always, but typically guys do, is really difficult. They're doing a version of what those editors of the newspapers do. They're surrounded by the trading volume on the ticker, the indexes going up and down, technical charts, single company stories, and throughout the day it is their task to articulate a narrative to explain what is happening. But I believe this commentary can get us disciplined investors into serious trouble. I have a few cheerfully cherry-picked examples to share with you. Let me start. If we had been suffering through the hideous volatility and uncertainty of the summer of the coronavirus with what Jim Cramer has for us, unexpected good news for investors, perhaps coming from an unexpected place. I want to play this clip for you. Hopefully it will be loud enough. Hopefully everyone can hear it. And then I want to sort of semiotically break it down. I want to examine why I think what Jim Cramer does here is so problematic for us as investors.
All because it looks like China beat it so viciously, David. They so tamped it down. Whether you call it the Chinese virus, I prefer to call it COVID-19. Yeah. But it looks like, David, China is back, and they're wearing makeup, and they're saving the Estee Lauder quarter. So you may not like that. I don't care. It's business is business.
Well, the spending in China has been significant, right? Yeah.
We saw that in Nike. The Chinese went through this catastrophic thing that we're trying to deal with, and they came out on the other side as gigantic buyers of things that are American. It wouldn't surprise me, by the way, if Apple didn't have a better quarter. There's a Skyworks note today, which is 5G, makes a lot of stuff for Apple, and says that they could pre-announce. So the companies that you wanted, this is rather ironic, David.
Yes.
The international companies you wanted, you should buy the ones that do well in China, because China's doing well for American companies. And
nothing one would have anticipated going into this pandemic.
Small, medium-sized businesses,
it's always the opposite. Right?
All right, David Faber might have the accidental wisdom comment there. It's almost the opposite. We'll come back to that. But let me start with what Jim Cramer does here. He starts with one analyst call. He starts with one company. And it's good news from this one company. What is that company? It's right there on the screen for you. It's the Estee Lauder Company. And I remember sitting in bed with my laptop open, I knew as a disciplined investor, as a diversified investor who holds a little bit of everything, somewhere out there I too was long Estee Lauder. And I was really thrilled for them. Why the good news? Well, again, it's hard perhaps to go all the way back, but in the summer of 2020, China had handled the coronavirus successfully. Many other markets had not. So Cramer's observation from this one stock, this one analyst call, is that because people can go out in China, they can go to restaurants. Because of that, they put on makeup. And because they're buying makeup, they're saving the Estee Lauder quarter. And I'm thrilled for the Estee Lauder Company. And I know, however infinitesimally small, I benefited from that good news. That is not my concern. My concern is what he does next. Because he takes that one call, that one stock that represents a tiny fraction of the total capital invested around the world, and he paints with a very broad brush to argue that the way to invest going forward is to concentrate in just a few large cap, famous US-based companies, your Apples, your Nikes, that are doing well in China, because China is now the savior of American capitalism. That, to me, is malpractice. Going from one analyst observation and articulating how I need to gamble on how a lot of US companies are going to do in just one market. Now, if we were tired of all the bad news, but we had been speculating on what was happening with the coronavirus, we probably were not ready for the bad news that Cramer had for us on that same day in September of 2020. For those of us who had been speculating around the fact that, like many other people, I was stuck in my basement. When I play this clip for you, I just want, as you're all aware, this is what they call the lower third, or the chyron. I want you to cast your eyes on this amazing chyron, which to my way of thinking should have won an Emmy Award. Let's play this clip back and talk about it.
Okay, so here's what's been happening. There are a lot of people who come on, and Mad Money knows shows, and they say, look, people have really changed their habits. They are now having soup, and they love soup, and after the pandemic's over, they're going to be drinking soup. Well, they are. They're just drinking it a lot less. And that's what Campbell's Soup said this morning in a rather disappointing quarter, because they also had some raw costs that were up. But Mark Klaus is a great CEO. But you can't just keep stocking your pantry when you can go out. And so look, if we had not had wonderful science like Pfizer and Moderna, then he probably would have had a great quarter. But if the fact is, the pantry stocking is over.
Okay, well, we're going to keep an eye on all of those names. So we're getting ready for an opening bell. Stay with us. We're ready.
You see how difficult investing is? We completely solved the riddle of the pandemic. There's only one way people are going to feed themselves going forward until the end of time. It's going to be canned soup. Now, according to Jim Cramer, people are going to be drinking soup. I think I eat soup. This may be a personal choice. But in any case, if we made that bet, everything was turning out great until, sort of Scooby-Doo style, those meddling pharmaceutical companies, also trying to make a buck, delivered vaccines that allowed people to go back out. And now, unfortunately, for those of us who were speculating, the pantry stocking is over. It's this idea that we constantly need to replace every narrative with a new narrative. And the only person who can tell us what to do next are these experts. That gets us into trouble. Now, before I move on to the last wave of what I believe is even more influential media, more influential than television, I do want to do Jim Cramer a solid because he did have one incredible, great tip. And I do want to share that clip with you. But before I share that clip, I want to check in. 1 year later, I repeated the experiment in the summer of 2021. How was Cramer's prediction about China saving American capitalism? How did that turn out for us? So let's watch this clip from the summer of 2021.
And thank you very, very much, Scott. Hi, everybody. I'm Kelly Evans. Here's what's ahead this hour on The Exchange. Big tech, ride-hailing, education, real estate, and now casinos are the latest industry to get crushed as the China crackdown intensifies. When will it end? Will it end? We'll explore what this all means for investors and tell you what Bridgewater's Ray Dalio says is the key thing to remember.
All right, a never-ending crackdown is not what I had hoped to receive for that bet on the savior of American capitalism. But to be fair to Jim Cramer, I will share this last clip with you. But don't worry, you don't have a ticker to write down or anything. It's not an investment tip. It is a cooking tip.
I do want to point out that Beyond Meat is good. They got a deal with Walmart, trying to get a little more from Ethan Brown. That is the millennial favorite. I had the meatballs. The meatballs were good. David, the meatballs were good for Beyond Meat.
We used something of theirs in lasagna recently.
Yeah, isn't it good?
Yeah, it wasn't bad.
Right. You never know the difference. Did you caramelize? You're supposed to caramelize the lasagna.
I don't know.
You didn't caramelize?
I was not involved in the actual cooking.
Well, you know to caramelize that stuff before you just eat it, right?
I have no idea what you're talking about. But they are.
So we'll give Carl Quintanilla solid points there for staying above the fray. To put a button on this, my thesis with investing TV, finance TV, it's very much like watching pro golf on television. I believe it's actually better with the sound off. Your mileage may vary. Let us get into our next acronym, FOMO. Who can help me out? Exactly. You all know exactly what I'm talking about. And you all know what it means to experience this when it comes to the social media triggers from our friends, neighbors, colleagues, loved ones who are clearly having way more fun than we are. The same thing can happen with investing in social media. So for a couple of years, I followed as many strong opinions as I could on Twitter, now X. And I want to report back some of my findings for you because to me, these are triggers that are far more insidious than what we find on television. Let me start with The Motley Fool. Now, The Motley Fool is simply an investing newsletter. It's a business model that's hundreds of years old. The Motley Fool is more than 30 years old now. But what I really find interesting about this social media advertisement is not necessarily the message, which is that if I'm starting late, I still can retire a millionaire after 50 by buying 5 stocks, possibly could be valid. It's not so much the message, it is the medium that they have chosen. You can see the art directors can present this any way they wish, and what they chose to do is to use a Sharpie and the back of a paper plate. To me, the subtle messaging here is if you do not invest successfully with us, this is what all of your meals in retirement will look like. You will be eating off of a paper plate. Perhaps that's a fear trigger. If it is, here's an incredible greed trigger, which I think on balance can get us into even more trouble. Still The Motley Fool. 5 years from now, you'll probably wish you grabbed this stock. Regret avoidance is an incredibly powerful force in our decision making. They have issued a rare all-in buy alert. Why? Because this company, and again, I don't know what the ticker is yet, I have to buy the newsletter to find out, it will be like buying Amazon at $3.19. Now, I am old enough to remember when Amazon IPO'd in 1997, and it has never been anywhere near $3.19. So my investing lizard brain knows that if this investment tip is even half right, that is truly life-changing money. But intellectually, I have to remind myself, if someone really has identified a company that's going to explode in a good way, that incredibly, why on earth would they sell that information for $19 in a newsletter? That to me is worth asking. That to me is a greed trigger. There's a lot of strange opinions out there on the internet. Katusa Research, are you paying attention yet? Uranium stocks are on fire. Now, I only took high school chemistry, but I know enough to know that when uranium is on fire, that is typically a dangerous condition for human beings. Is this good or bad news? I don't even know whether it's fear or greed. I have to watch an exclusive interview with one of the biggest names in the uranium sector. They never do interviews with Western media, always a sign of quality. It's an absolute must-watch, and you can see it's been accompanied by the #1 catnip on investing Twitter, which is a perhaps genuine, perhaps faked Bloomberg screenshot. I don't know what happens when the yellow line and the white line intersect. I don't know if it's good or bad news, but of course, I have to watch more to find out anything they can do to get me to transact. In the last few years, especially during the rise and then swoon of Bitcoin, a lot of people started to sell against Bitcoin. This was a company that was targeting people to invest in fractional shares of fine art. I don't know exactly how that works, but they wanted us to forget Bitcoin. I want to close this chapter with my own kind of personal FOMO, perhaps. This is a photograph that I took expressly to bring to you here tonight. It is now almost 2 years old. And this was, I will admit, during a summer where Bitcoin was having some trouble. It has recovered some of its value since then. But I still want to share it with you because it came with an incredible kind of wave of self-awareness, or as they say, satori. So I went into this I bought gas, and then my child convinced me to buy some terrible candy for him. So I went in to do that. But on my way out, I noticed that, yes, there was a new sign on the door. I could finally buy Bitcoin at the gas station. But then I sat down in the car and I had this wave of insight. So I grabbed my phone, I came back out and took this picture because it occurred to me in a flash, even in a really tobacco-friendly state like North Carolina, everything advertised on a gas station door is bad for you. This is not a commentary on cryptocurrency, its utility, whether or not it is of investment grade. I'm not saying that, simply to say it's not in great company. I want you to resist the urge to benchmark your investment success to your neighbors, either in person, which is easy to do, or on social media. Let us head toward our conclusion, which gets a little more serious. One more, perhaps fun example, CYA, and of course for our purposes that will stand for Cover Your Assets. The fawning coverage of successful entrepreneurs in the media, like this cover story, Jeff Bezos appearing on Fortune magazine, not for the first time, in April of 2016, I believe can get us into real trouble. Because even I, with my significant education and experience in investing, when I see this cover story, and it's 2016, it's not 1997. Amazon has already IPO'd. Amazon's already had an incredible run-up. When I see this cover story, when I look into Jeff Bezos's, disintermediating gaze there, I can think of only one thing: ice hockey. What do I mean by that? Well, I know that the success that's associated with this man is that incredible ice hockey stick shape that he and his management team delivered to people who did make an early investment, either at IPO or privately pre-IPO. That exponential growth, that is the hockey stick shape that investors dream of. But sometimes the dream can be a nightmare. Now, Jeff Bezos has delivered that hockey stick shape once. But if I read this cover story in 2016, can I go back and invest in that experience, 1997 to 2016? It is not available to me as an investor. That is in the past. In order for this sentiment to work out, Bezos needs to deliver a second hockey stick. That is incredibly rare. Fawning coverage doesn't always work out. And here's perhaps unfairly infamous example: Elizabeth Holmes on the cover of Fortune magazine. Now again, thankfully for all of us, Theranos never went public. Hopefully no one in this room lost any money. But I really include Elizabeth Holmes, not because of her company, but because of her sartorial inspiration, the entrepreneur that inspired her. And that would be this guy, Stephen P. Jobs. And he too appeared on these magazine covers way back in 1982. Far back enough that when you appeared on the cover of Time magazine, they made an oil painting of you. Why is he on the cover of Time magazine in the winter of 1982? Well, the Apple Computer IPO is only 15 months old, but it is the #1 returning stock in the US stock market. Striking it rich is an accurate headline. Now, I missed that boat. As a reader of Time magazine, I wait for the media to tell me who the successful entrepreneurs are. So if I see this oil painting and I like that computer, or perhaps more likely I like that mustache and I want to invest in it, Steve Jobs has delivered a hockey stick to his early investors. Will he deliver a second one? That is not a rhetorical question. You are here in the year 2024. You know the answer. The answer is he will. How patient an investor do I need to be if I make a bet on this dude and I wait for the next hockey stick to show up in the mail? I have to be incredibly patient. How patient? Well, just 5 years later, Steve Jobs is fired as president of Apple Computer. He is now out of the company that he founded. I still need to hold that position. Apple Computer gets killed versus cloned PCs. Apple Computer is now trading at 20 cents on the dollar at the peak when this magazine issue was published. I need to hold that position through cover stories like this. This is 1997. I've been in this position for eons, underperforming the major stock market indices, and Wired magazine characterizes the Apple icon as a religious icon. That is how deep in trouble Apple is. I need to hold that position through cover stories like this in order for Steve Jobs to come back, excuse me, and issue and create products like the iPad, iPhone, iPod, etc. That second hockey stick shape did show up, but I really can't imagine there are many patient investors who would have held that position through uncertainty like this. Must we bear uncertainty as investors? You've already heard my argument. We must. But there are different kinds of uncertainty. There's the uncertainty that comes with making a single bet about a single entrepreneur. That is not the only way for us to experience the benefits of investing. Suffice it to say that excellence, especially in the media, can be illusory. Media coverage is all about the past. On a material level, it tells you nothing about the future. And the future is where I want to come to a close with you. YOLO. You only live once. Depending on your metaphysical view, that may or may not be true. But as investors, let's stipulate that we have one investment lifespan. And this gets us to the practicality of today, of 2014, not what happened 5 years ago or 10 or 15 or 20 years ago. I'd like you to conduct the following thought experiment because I think it is incredibly useful for our purposes in considering what uncertainty can we bear today and in the markets and the uncertainty that markets will provide tomorrow. In March and April and May of 2020, I spent a ton of time, you already know where I was in my basement, but I spent a ton of time on Zoom talking with investors about this incredibly unique situation. We had not experienced a pandemic like this in going on 100 years. And many investors told me when they saw cover stories like this published in March 21 of 2020 that this is accurate. Global capitalism is closed, not permanently, but looks like it's going to be a while. And until we get this sorted out, I can't take this kind of heat. I got to get out of the kitchen. Doesn't mean I'm going to cash. But it does mean I'm not buying any more stock. I'm not even buying any more bonds until we get this uncertainty figured out. And when a cover story like this was published, we had already experienced that drop of 20%. Markets already deeply discounted in just a matter of a couple of market hours. This is the heart of the thought experiment. I asked this of investors and myself, I have to admit, in March and April of May of 2020, not knowing how that year would turn out. I asked them if this is the signal that you have to get out. You have to trim your sails. You have to reduce your exposure to uncertainty. You have to go to cash, however you characterize it. Well, what's the cover story that tells you it's okay to get back in the water? And at that time, it may sound naive now, but in March of 2020, you can guess what that cover story was. Without fail, this is what people are asking for. Well, I want the vaccine to show up, I want it to be medically approved, and I want everyone to take it without asking any questions so we can all go back to regular life. And here in 2024, that sounds a little naive, but I think during those really dark days in 2020, this was the headline people were waiting for. And it was a headline that came to pass just 7 months later. Now, this is the heart of the thought experiment. You can conduct it in March of 2020, we can conduct it now. When this sign that the uncertainty is over and that wave has crested shows up, when that headline shows up, do we expect capital markets to be waiting, discounted at 18,500? Or do we expect markets have already largely recovered? I would expect markets to have already largely recovered, and indeed they did. When this cover story was published, not only had markets recovered the losses of March, markets were at yet another all-time high. Why did the markets recover? Why did people who stayed invested get rewarded that way? I argue not despite the uncertainty of the pandemic, but because of it. But because they were willing to bear an uncertainty that another investor was not. I don't say bearing uncertainty is easy to do. There are different ways to do it. And again, you've been really patient because so far we've only talked about the past. We have not talked about the future, but the future is where all of your future returns lie. It's about bearing this, the next instant message you're going to receive. It may be good news on a personal level. It may be unfortunate and hideous bad news on a personal level. That too can affect our confidence as investors. It may also be at a global level. It may be good or bad news on a global level. Goodness knows in the last 4 years we've gotten big doses of that. How can you be set up to withstand that uncertainty? I want to argue, if you're hearing my voice right now, you have a great investment plan. You are diversified. You have objective advice. Not every investor has those three things. Not every investor pays for them. I believe those three things give you a powerful choice as an investor not to react, not to respond to the fear signals that you see in the media, not to respond to the greed signals that you see in the media that can be just as problematic. Let me close with this story and see if you have any questions for me. Some people love to ask questions when everyone else is listening. If so, your moment of glory is soon at hand. Other people prefer to ask questions one-on-one. Either way, I am thrilled to interact with you in the next few minutes. Let me close with this story about this choice. And I was reminded of this story in those months when the pandemic, even though at the end of the day the morbidity and mortality wasn't all that bad, it was stressing out our medical system in just about every large city in the United States. And I remember a story a good friend of mine from college told me. She went on to become a physician, way smarter than I was. And she became an MD. And this was many years before the pandemic, but she'd shared with me her story, the scariest night she had as a resident. And as I'm sure you're all aware, to get into medical school means you're really good at book learning. And even a lion's share of medical school itself is still book learning about chemistry, physics, biology of the human body. If you can master all of that, eventually you open up a cadaver. And if you can do that, eventually you get into a residency where for the first time, after all that book learning, you're actually putting your hands on a patient. And in North America, everyone's residency starts in the same month, it starts in August. Which is why my friend said, don't get sick in August. Not because these new residents are stupid people, they most certainly are not, but because they are not experienced. They are only book knowledge. They haven't dealt with actual human beings. They haven't dealt with real emergencies yet. For her, the scariest night in her residency was her first night in the emergency room. That was one of the specialties that she considered in her medical career. And on that first night, the attending physician brought all the medical students together, and the attending said, here in the emergency room we have a unique watchword. We have different rules here. Because tonight in the emergency room you may treat people who are traumatized, who are injured. You may treat people who are drunk or high. They may be dangerous to themselves. They may be dangerous to you. And in that moment, they're going to have adrenaline going through their bloodstream. You're going to have adrenaline going through your bloodstream as you care for them. That's why our word in the emergency room, our watchword, is don't just do something, stand there. If you respond to the first piece of data you get, if you act rashly, you can kill a patient in the ER really quickly. That's why our watchword is don't just do something, stand there. Let's gather as much evidence as we can, even in a matter of minutes. Let's get as many labs as we can, even in a matter of minutes. Let's talk to as many attending physicians as we can, even in a matter of minutes, to determine a course of action. When in doubt, don't just do something, stand there. And I thought of that during the pandemic because our view of markets at Dimensional is that no one controls that price movement. Capital markets move super quickly. I have not given you specific examples, but I would be happy to if you want to interrogate that. And because of that, if we are diversified, it is often better not to respond to the signals that we see in the media because because all of those signals are already baked into the prices that markets present us with. I believe that happens on a time scale, not of years or quarters or weeks, but of minutes and of seconds. If you're not a diversified investor, if you're concentrated just in the Campbell Soup Company and the pantry stocking is over, guess what you have to do? You got to respond. And if you are timing markets, if you get out of markets because you can't take the heat, you got to get back in eventually. There are people on the planet who can afford to live only on bonds. I've never met them. Well, maybe one or two. Most of us want equity exposure. Most of us want to own shares of companies and shares of stocks because we expect them to grow more rapidly and reward us for bearing that uncertainty, for buying that uncertainty from someone else. Not everyone has this choice, a choice not to respond. Doesn't mean you won't respond. But rather than making that decision on your own, you want to work with someone who has what you don't, who has objectivity about your wealth. You cannot fake objectivity about yourself. Your advisor has that objectivity. And I believe if you are diversified, if you have an investment plan to do the responding for you, if you have objective advice, you have this choice no matter whether the signals are good or bad, optimistic or pessimistic, personal or public. You have a choice as an investor not to respond rashly. Thank you so much for your time and your patience in hearing out my argument. If there are any questions about Dimensional, what we do, what's happening in the world, I don't really want to call this evidence, but the examples that I shared with you, I'm happy to do that in front of everyone. I'm also going to stick around, of course, if you'd rather talk one-on-one. Thank you very much.